One reason our next guest says private markets could offer investors respite from these stomach-churning swings. Let's bring in Brian Feurtado. He's partner and head of family office business at Apollo Global Management. Good to see you.
Scott, it's great to see you again.
Yeah,
thanks for having me.
These are kind of crazy times, obviously, in the market. From your perspective, how do you feel about it?
Yeah, no, incredible times. I mean, really volatile right now, obviously. And, we see this as really just an adjustment phase. Obviously, we're looking closely right now at consumer sentiment, at corporate sentiment, and just watching closely to see how, those reactions happen. We've been looking at some of the data there, and, it's clear that that's getting a little softer on both fronts. And so that's going to mean that we have to look closely at unemployment levels, going forward, and potentially, what happens there with the Fed. So these are big changes that could be coming. Obviously, the jobless claims today was a little better than expected, so that's a good sign. But more volatility, but means that, as investors, we ought to be thinking more about diversification, for sure.
And how so are you doing that? I mean, the equity market is obviously volatile. Credit's been pretty good.
Right.
Spreads are, widening a little bit, but nothing to raise the alarm bells.
Yeah, no, on the credit side, spreads are pretty tight. So there, we can talk about that in a minute a little bit in terms of what we're doing there to kind of improve on that. On the investment grade side, spreads are very tight. But if you look at, and I think we could talk about this in terms of equities and credit, in terms of just thinking about how do you replace those exposures, but do it in a less volatile way. And I think that's the most important thing in these markets right now, because the markets are moving so quickly. And so the promise of alternatives, obviously, and Apollo is obviously very focused on that for our clients.
Sure.
And blending those into portfolios. So we're seeing the super large family office clients, really think about like how do they, get more liquidity in their portfolios, because obviously family offices have been somewhat overloaded, in private equity here, just like endowments and big institutions. And so they're looking to improve their liquidity, not necessarily go into liquid markets, but sort of that middle ground of semi-liquid alternatives. And then likewise, at the other end of the spectrum, the high net worth investor is looking to get more alternatives into their portfolio, get more diversification in their portfolio, and get more semi-liquid structures. So they're sort of meeting in the middle, if you like, in their portfolios right now.
This was thought to be, and I think there was a lot of optimism coming into the year that private equity was going to have a great year.
Right.
Realizations were going to be up for, the first time in a while. You guys have been sitting on a lot of stuff you want to get done, and it feels like that's pushed off.
Right. Yes.
I loved what Robert Kaplan told me a short time ago, the former Dallas Fed president, when talking to his clients about doing things. It's not no, it's not now.
Yeah, just not, and certainly not now, because, and this is the uncertainty that this is really creating is meaning that, things are getting pushed off, IPOs getting pushed off, et cetera. And so we're seeing somewhat of a slowdown there, but we're seeing companies actually, and sort of a lot of private companies looking in the middle at like what we're calling hybrid structures. So they're looking for equity capital, but they're also looking for creative solutions. We call it structured equity. And so they're looking for lending and collateralized investments, but alongside an equity investment to unlock some ability for them to do things in their businesses. So that's an interesting area in the markets. And it's another way of getting diversification, back to your original question, in portfolios. We've got to be thinking a little bit differently, I think, in these markets, because just the regular way 60-40 portfolio is probably not a great place to be here.